Hello and welcome back. As I said in the previous lesson, we'll look at the termination payments in this lesson. Now, termination payments are the payments when the contract is terminated, when an employee is kicked off out of the company, or he may leave voluntarily, or the contract is finished. So whenever any payment is made, so we'll have to see if there is any tax payable or not. Now, there are three types of payments. Termination payments actually. So one is fully taxable, other one is partially taxable, and the third one is totally exempt, so we don't have to pay any tax on that. I'll just share the screen with you, and as you can see on the screen now, on page 24, at the end of the page 24, just beneath the last scheme, share incentive plans, which was seen in the last lesson, here you go. It is payment on termination of payments. Now, termination payments may be entirely exempt, partially exempt, or entirely chargeable. So there are three types of them. One is fully taxable, other one is partially taxable, and the third one is totally exempt. Right? The first one is absolutely exempt, so you don't have to pay any tax on that. Payment on account of injury, disability, and accidental death. So if you have been injured while you're working, or you died accidentally, or you become disabled, and if any payments has been made on that, and then that will be exempt. Now, lump sum payment from registered pension scheme. So when you have registered yourself for the pension scheme, when you get the pension, when you get the lump sum amount out of the registered pension scheme, then you don't have to pay any tax on that either. Now, the last one of these is legal cost covered by employee. Legal costs recovered by employee from the employer following the legal action to recover compensation for loss of employment. Now, say for example, if an employee was working for a company and everything was fine, then the employer has kicked off the employee, which was unfair dismissal. Now, employee spoke to the employer and said, please do not kick me out. How can I go out because I did not do nothing wrong? Then employer said, no, you will have to leave the company. I'm sorry for that. Then the employee thought, why shouldn't I go to the court? Then the employee go to the court, and the judge gives the case in the favor of employee. Now, employer has to pay some compensation to the employee. That compensation will not be taxable. That will be exempt as well. The second one is fully taxable termination payment. Now, these are fully taxable, no exemption at all. The payments to which the employee is contractually entitled are taxable. Now, when the contract is made and the employment contract has started, there will be written each and everything in it. Now, whatever has been part of contract, whatever the payment is part of the contract will be taxable, just like the salary and the benefits. Now, there are few here which are taxable. Payment for work done, terminal bonuses for doing extra work during a period of notice. Now, say for example, if my boss says, could you please do extra work, could you please do extra time tonight, now that will be taxable because I will be paid for it. Payment in lieu of notice, where stated in the original contract extending a period of notice. Now, lieu of notice is simply amount then whereby employer says that you will have to leave the company, but it gives us some notice. And when it gives us some notice, it also gives us some extra payment. Now, that is also fully taxable. Next one is a payment by one employer to induce an employee to take up employment with another employer. Now, say for example, my boss says that could you please go to another tuition provider and provide the lectures there as well. I'll give you some extra amount. That money will also be taxable. Payment from unregistered pension scheme, these will also be taxable. However, if you remember from the previous section, a registered pension scheme lump sum amount taken will be exempt, whereas this is unregistered pension scheme. An employee accepting a limitation on his future conduct or activities in return for a payment, restrictive covenants. Now, you might have studied this at F9 or P7. Now, restrictive covenants are simply when you're working for an you might be working for a government agency, say for example, which is a secret agency or FBI or something like that, then in them companies, what they do is when you get retired, the companies say that you cannot work for no one, you cannot work anywhere for a specific period of time, say for example 3 years after getting retired. But the employee will say, if I sit idle at home, are you paying me something for it? The employer says, yes, we will pay you for that. Now it is called restrictive covenants. Say for example, if I get retired from AccountancyTube, my employer says you should not work for no one for 1 year, but I will give you payment for sitting at home. So that is called restrictive covenants. So they will be fully taxable as well. Now beneath that, the last one is called partially exempt. Now this is partially exempt. Why is it called partially exempt? Because the payments you are getting, the list of payments which you are getting, if they are partially exempt, will have to total all of these. If the total is £30,000, that will be exempt. So first 30,000 if you receive are exempt. If you receive more than £30,000, that will be taxable. Now it says other payments are on termination are partially exempt. First 30,000 is exempt. Any excess is taxable. Now these are ex gratia payments. Ex gratia payments are payment when you get retired from a company, your boss will give you an extra amount. So to motivate you. So when you go out of the company, I will say each and every person that my boss at AccountancyTube was a nice guy. When I get retired, he gave me say for example £10,000 check. So I will be talking about AccountancyTube boss each and everywhere. I will be telling everyone that is a nice guy and that is a nice company to work for. So that is called ex gratia payments. Next one is a compensation for loss of office. So if I go out of this company, if I lose my job, then if any payment is given, that is partially exempt as well. Payment for unfair dismissal. If I am dismissed unfairly, then if I get any payment, that will be partially exempt. Statutory redundancy pay. If I have been made redundant, if I have been kicked out of the company, or if my contract is finished or something like that, so if I have been made redundant, and then if the redundancy is statutory, then there is statutory redundancy pay as well. Now it will be written in the contract, if I have been made redundant, then the employer will have to pay some amount. That is called statutory legal pay. So employer will be legally bound to pay me some amount. That is called statutory redundancy pay, and that will be partially exempt as well. Alright. After that says any benefits, e.g. car, mobile phone, provided calculated under normal benefits rules, they also will be partially exempt. Employers have an obligation to report termination settlement to HMRC by 6th July following the tax year end. So our tax year concerned will end on 6th of April 2016. So we must inform by 6th July 2016, right? So that was a termination payment. That is end of it. The next chapter is chapter 6, trading profit adjustments. We'll see in the next lecture how to calculate the trading profit. But to give you an overview in this lesson, I'll just give you the overview. Now, from your earlier studies, because you have studied accounting a lot, so you have been studying lots and lots of accounting, financial accounting, management accounting, corporate reporting, financial reporting. There's lots and lots in ACCA. Now, what you have been doing there is you have been making some financial statements. Now, one of the financial statements was a statement of profit and loss, where your end figure was net profit. Now, when you're making accounting profit, the ones which you're making in your financial accounting or management accounting, them were called accounting profit, or you can say trading profit. Now, them trading profits were made according to the accounting date, and that's why them were called accounting profits. Also, if you remember, when you deducted the expenses out of your income while calculating statement of comprehensive income, you deducted almost each and every expense which were incurred in the business. You did not consider any tax perspective. You did not consider any taxation issues while you are making your statement of comprehensive income. However, when HMRC people, when we tax people, look at the statement which is made by a management accounting. Now, when we are studying P6, please assume yourself as tax expert. Do not confuse yourself with management accounting. you are not management accounting, you are a tax expert. So management accounting will be someone who is expert in management accounting and who will be making management accounts. So when you are working for a firm and you are a tax advisor, when you go to a company, you will ask management accounting to give you management accounts. So when he will give you management accounts, one of the accounts will be a statement of comprehensive income. Now when he made the statement of comprehensive income, he did not know any rules of taxation because he was management accounting. So when you looked at the statement of comprehensive income, you will see that he has made a very nice presented income statement. But there are some mistakes as far as taxation is concerned. So when he made the income statement, he deducted each and every expense without considering taxation. But when you will look at the income statement, you will have to see that some of the expenses which he deducted should not have been deducted as far as tax is concerned, because we will make adjusted trading profit. We'll adjust the trading profit what he has already made. We will add back the ones which he has deducted because they should not have been deducted in first place. So what I mean to say is a traditional income statement which the management accountant makes, it is not relevant for tax people. So the tax people will adjust that income statement. So some of the expenses which have been deducted according to accounting will be added back, because that's what tax people do. Some of the expenses which have not been deducted while making the income statement, we tax people will say these expenses should have been deducted, so we will deduct them as well. So we will do these bits and pieces in this trading profit, right? Now here on the screen it says trading profit adjustments on page 26. Now net profit before tax as per accounts. So as I said, when you look at the income statement, so it will be net profit before tax, and we will put that amount here, net profit as per accounts. Now what we will add here is expenditure charged in the accounts, which are charged by management accounting, which have been deducted, which are not deductible. So we will add them back, which should not have been deducted. So we will add them back. The next thing we will add is income not charged in the accounts which are taxable. Now when he made the income statement, he forgot to put some incomes. So we'll put them incomes here as well. The next one is we'll deduct two things out of this. So one is income in the accounts which are not trading profits. Now he has included some incomes which should not have been included. So we will deduct them out as well. And the last one is income not charged in the accounts which are deductible. And there are some incomes as well which should not have been expenditure not charged in the accounts, which should have been deducted there, but management accountant did not deduct it. So we'll deduct them as well. Now the balance of this will be trading profit adjusted for tax purposes. So this is the profit which we will use. This is the profit which we need to be. Right? Now beneath that it says, it gives you the list of things which will be added. Expenditure charged in accounts which are not deductible, not allowed. Now these are expenses which you normally see in your management accounts, which you normally see in your income statement, which are fines and penalties, depreciation, amortization, general provisions, bad debts, capital expenditure, and blah blah blah. There are lots and lots of them. Now these are the things which, if they are deducted, you must add them back. Right? Now another thing which you will add is income not charged in the accounts which are taxable. Now these are the incomes which are not charged. We must add them back. Sorry, not add them back. We must add them because they haven't been added in the first place. Drawing of stocks and assets by proprietor at its market value. So if anything has been withdrawn from the business by the proprietor, we must take the market value of it and we must add that in the income statement, right? Because this is income, although it has been withdrawn by our boss, by the proprietor, but it is income as far as the income statement is concerned for taxation. What we will deduct out of this is income profit included in the accounts which are not trading profit. Now these were the things which were included, but we will have to deduct them. The first one is the profit and sale of assets. So if the asset is sold, and if any profit was made, so we'll add So we will deduct that as well. Rental income from property. So if there is any rental income from property, we will deduct that too. A premium received on grant of lease will also be deducted. Interest received or dividend received will also be deducted. The last thing which we will deduct, these are the expenditure not charged in the accounts which are deductible. They haven't been charged in the first place, so we'll deduct them. Capital allowances. Now capital allowances, as I said, we will see in next few chapters. In a couple of chapters we will see capital allowances in detail. The capital allowances is simply a depreciation, tax depreciation. It is not accounting depreciation. So in accounting it is called depreciation. In taxation it is called capital allowance. Now it may not be the same like depreciation as far as amount is concerned. It may be more than that or less than that because we are considering the tax perspective. Now as you have seen that we have added back the depreciation, now we are deducting the capital allowances, so it is tax depreciation. And another thing is pre-trade commencement expenditure incurred up to 7 years before trade. So if you haven't started the trade yet, say for example this AccountancyTube has incurred some expenses before it was even launched, right? So them expenses, if they were incurred up to 7 years before launching, they are deductible. Now in the notes it says rarely if deductible expenses are not included in the accounts, then it must be deducted. So if they are not deducted, then must be deducted. Any expense not in above list must be ignored as they are allowable. If there isn't any expense, they must be ignored. Now at this level, at P6 level, examiner won't examine you this bit in much details because he has already examined in F6. So he won't expect you to make a full pro forma where you will be adding and deducting things out of this, because this is the thing which you should have been doing at F6 level. So obviously as far as F6 is concerned, this is important, but at P6 level this is not important. But because we are studying, so we must consider this. There is an example beneath that which is adjusted taxable trading profit. Excuse me. Now this is an example and the answer is also given beneath that. And now please make sure you read this one because I'm not going to do this one. That's why I put the answer with it as well. So before looking at the answer, please make sure you do that. You try to attempt it. Then please make sure you check with the answers which is given on page 28, the next page. Please make sure you check the answers what you have written and how far have you gone, where you went wrong, and these bits and pieces. All right. Now please make sure you do that. After you have done that, we will see basis period in the next lecture. All right. That's it for this lecture, and I will see you in the next lecture. Thank you and goodbye.